We all need to make smart decisions with our money. The Long-Term Investor podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
Welcome back to The Long-Term Investor, and boy, do we have a great conversation for you. This episode was recorded live at CFA Live, the CFA Institute's global annual conference, and my friend Brian Portnoy and I shared the main stage to talk all things behavioral finance. You'll hear why the traditional view of investor psychology may be too narrow and what's replacing it. Brian also shares a powerful 5-step framework for navigating market volatility, the role of storytelling in more meaningful client relationships, and what the rise of AI means for the future of financial advice. And I am also excited to share right now on this podcast for the first time, I am writing a new book that will be out in the summer of 2026. It's called The Perfect Portfolio, and I'll be offering exclusive updates, early excerpts, and special bonuses to subscribers so you can sign up to subscribe for those updates at theperfectportfoliobook.com or just click the link at the top of this episode's description. Now, let's dive in to my conversation with Brian Portnoy.
Hey, everybody. My name is Peter Lazaroff. I'm the Chief Investment Officer at PlanCorp. We're an RIA based in St. Louis. We manage between $7 and $8 billion, depending on what the market is doing. And I'm also the host of the Long-Term Investor podcast that's nationally syndicated. And today's conversation will actually be publishing on May 28th. So if you want to go to thelongterminvestor.com, you can subscribe anywhere where you listen to podcasts. My guest here today is Brian Portnoy. Brian, I think you can do a better job of giving your background because I think we're talking about behavioral finance, fascinating topic. But I also think it's one that doesn't necessarily get covered in the right way anymore. And I was really excited when I was able to hear that you were joining me today to talk about this topic. Maybe give us a deep background. You've done a lot of things in the space.
Cool. We have 56 minutes and 12 seconds. I'll leave 2 minutes at the end for questions. I actually started my finance and investing career here in Chicago at Morningstar, a boutique little investment research shop that maybe some of you have heard of. But when I was there were 350 people. It was an amazing experience. Fast forward through now a 25-year career in the industry. A good chunk of that has been on the investment side, investment research, portfolio management. I worked for one of the bigger fund of hedge funds in town for quite some time, was the director of research there. So I've managed large portfolios of complex investments, lived in London for a while. Actually, the keynote speaker was talking about 2008 flash memories. We lived in London with our family at the time. It was a hell of an experience. And about 12, 13 years ago, I was sort of stepping back. It was one of several midlife crises that I was experiencing. And I began to start reading in social psychology, behavioral finance. The very first book in the space that I read was not Kahneman and Tversky or Thaler or Ariely or any of those legends. It was Sheena Iyengar's The Art of Choosing, which is a beautiful research, but also meditation on how choice and agency fits into a life well lived. And it was just a real light bulb moment. And so fast forward to now, I've written 3 books in the field of applied behavioral finance, published in 15 languages, which I'm kind of proud of. And one of them is called The Geometry of Wealth, probably what I'm best known for. The first book, called The Investor's Paradox, was how to pick better mutual fund and hedge fund managers through a behavioral lens. And that was a fun project. Toward the end of that project, I said, well, what does this really matter? And so I stepped back and thought more broadly about where money fits into a meaningful life. So the Geometry of Wealth sort of took off. And at a certain point, I decided to take that on the road, so to speak. I transformed the Geometry of Wealth into Shaping Wealth, which is now a global content and coaching platform. We work with Peter's firm, PlanCorp. We work with firms on 6 different continents. If anyone here knows any financial advisors in Antarctica, I am desperate for that win. But in the field of what I'll call applied behavioral finance, and we're going to get into how broad that is now, because it's just not judgment and decision-making, it's emotional intelligence, it's positive psychology. It's a lot of really fascinating and dynamic fields that map to the dynamic element of the wealth industry, which is going beyond just managing client portfolios and really digging in more deeply into conversations about a life well lived and where the money part fits into all of that. So I've got a team of experts in financial planning, psychology, neuroscience, and we create content, workshops, courses, seminars, you name it, both live, asynchronous. We have a content platform called Compass. You are the guide, we are your compass. So compass.shapingwealth.com. It's a free content platform. Hundreds of pieces of bite-sized read, watch, listen on the human condition as it intersects with financial planning and money management.
Wonderful, because I think what you all get the feeling is why I asked Brian to join me today. We're going to be talking today not just about the evolution of the investment profession and how we can become better investors or advisors through a behavioral lens, but I think because I have experienced some of the behavioral coaching that Brian's company does through Shaping Wealth, how I've seen it's impacted our advisors, and how I myself am applying behavioral insights into real client conversations, you're all going to learn a lot here today and go beyond that base level of behavioral finance. But before we get into that, I thought we maybe would just start, whether at the macro or micro level, what do you feel like the average investor is thinking and feeling today?
From the headlines, what the hell's going on? There's never a time when things are certain, but it feels like there's a lot of moving pieces right now. I actually just did a talk a few nights ago to 1,000 mom and pop investors, and it was a really fun experience because I got to watch the chat go as I was giving my remarks. And where is this all coming from? The pace of change, whether it be politics or AI or other major macro and micro influences. I think there's the question of not just, hey, what the hell's going on, but is this normal? Has this happened before? We are deeply wired to be pattern-seeking creatures. So we are always reflexively, you really can't escape it. We're looking at the world and saying, what is this like? So we did a fun piece at Shaping Wealth not long ago. One of my partners, Dr. Joy Leary, who's an amazing professional psychologist, expert in financial therapy, all-around wise person and empath. Well, her husband's a very senior officer in the U.S. Air Force. They've lived all over the world. And she introduced this concept that the U.S. military created 30, 40 years ago, maybe during the time of the Berlin Wall, so called 30 years ago. So the concept is VUCA, volatile, uncertain, complex, and ambiguous. And it's a concept that the U.S. military put into place to sort of describe and capture these punctuated moments where you say, is this normal? What's really going on here? VUCA, volatile, uncertain, complex, and ambiguous. And one thing I'll add to that VUCA mindset, because I think that's where we're at a VUCA moment, is that the human mind is wired to have certain reactions to this depth of uncertainty. There's a few ways that we're sort of reacting and groping, and I think it's important to take note of these because it gives us an entry point to better client conversations, managing employee expectations, things like that. So in VUCA moments, number one, we're reaching for narrative. We're going to talk about storytelling at a certain point, I believe, but let's never forget that we were not born as calculators, we were born as storytellers. So we're always looking for the story that makes sense, especially during VUCA moments. We are looking for control. We don't like environments where we feel like we don't have much control. Back to that book I mentioned, The Art of Choosing by Sheena Iyengar. So much of that book is about the power of agency and what it feels like to have control versus things being very out of control. A third element of these VUCA spikes in terms of how humans react is that we reach for community, we reach for tribe. What is everybody else around me doing and thinking? Again, there's no getting around some of our hard wiring as it relates to our need to belong, that sense of connection. If anything, the tribe gives us a sense of safety, not only physically, but psychologically. So what's on the investor's mind? They're scrambling to find the patterns. They're scrambling to find the connection. They're scrambling to find the stories that make sense at times like this. And what's awesome about this conference and the types of people who are here is that we're very well positioned to bridge that gap and do some good for our clients.
There's so much in there. You mentioned storytelling. You're referencing a lot of the way that people feel. And I think of my introduction to behavioral finance. I feel like Jason Zweig's Your Money, Your Brain was the first time that it occurred to me that something other than what I learned in school is impacting the way that my clients are behaving, impacting the way the investment committee is behaving. I remember sitting on an investment committee where we're picking individual stocks, and it was like a hotbed for a behavioral finance textbook. one of the things I enjoyed about it then was this, oh, look at those silly little human moments where you can identify and recognize all the behavioral biases, whether it's recency, loss aversion, overconfidence. But what is also standing out to me in your experience and in books that you've written, like The Geometry of Wealth, is that instead of just pointing out these behavioral quirks that make us human and are perfectly normal, totally fine to feel and important to recognize, you actually have gone a level deeper, in my opinion. I've heard you from time to time call it behavioral finance 2.0.
Right.
Can you talk a little bit about that?
I love the feeling of standing on the shoulders of giants, following my heroes like Kahneman and Tversky, who basically in the 1970s were looking at how people make decisions. And they're like, let's look over to the US economics profession. They're really smart and successful. Let's see how they conceptualize human decision-making. And they said, my God, they don't have any idea what they're talking about. So they went ahead and invented a whole new field of investment decision-making called behavioral finance. If you don't know the history, it's not hard to make behavioral finance interesting because it's the psychology of money. So Michael Lewis published a book called The Undoing Project some years ago, if you want to get into social history of behavioral finance. So there is this unbelievably rich legacy spurred by those two gentlemen and carried on by Dick Thaler here at the University of Chicago and many others, broad-ranging, complex, fascinating. The challenge is that as the investment industry and the wealth management industry connected to learned from this, for one reason or another, just call it an accident, just call it evolution, we've focused on such a narrow piece to what those wonderful scholars taught us. And specifically, all we talk about almost all the time is biases and heuristics. I took the CFA exams 25 years ago, so apologies that I can't remember what was on them, but I don't remember it being a big part there. And the extent that people find behavioral finance interesting, they want to lean into all of these quirks or biases. Loss aversion, the endowment effect, recency bias, confirmation bias, mental accounting. There's literally like 190 of these. Go to the wiki page. And it's not that it's wrong, but it's so terribly incomplete. It has led the investment and wealth industry in directions that haven't been particularly fruitful. And I'll punctuate it by saying that basically what we've done as an industry is pathologize normal human behavior. We've pathologized normal human behavior by saying you are flawed, you are irrational. Irrational is nothing more than an economist's fancy word for stupid. We spend a lot of our time calling our clients stupid. We use the word irrational. Advisors have reacted very differently to the last couple months, good versus bad advisors in my view. So let's broaden the lens, let's widen the aperture and start not with human beings as flawed, but instead human beings as being normal and having a whole series of really fascinating adaptations to a complex world that we've evolved through millennia. And with that, we can pivot in a variety of different ways that answers not how can we be less rational, but instead, how can we flourish? How can we live lives of meaning? How can we live lives of purpose? Because to be honest, whether you're a portfolio manager or a financial advisor, almost none of the time is your client saying, geez, I hope there's a little bit more alpha in this portfolio. No, they're answering foundational questions as to, am I going to be okay? Are my loved ones going to be okay? How much is enough? Where does money connect to happiness? Those are the bigger picture question that our clients have in mind. So we can move on, what I call going beyond bias, BFI 1.0 to 2.0, and we go from it being an emphasis on analytics and now adding some balance into empathy. So to me, in the age of AI, emotional intelligence is everybody's superpower. Self-awareness, self-regulation, empathy, relationship skills, leadership skills, and so forth. So BFI 2.0, it's not that it's not analytic, but it leans into empathy. Numbers versus story. BFI 2.0 recognizes that we weren't born as calculators. We were born as storytellers, and that every one of our clients, every single person in this room is living a story, a series of stories. And we are more or less aware of those subconsciously, consciously. And when our clients are working with us, the focus isn't just, well, what do I want to do or what do I want to own? It's also, who am I going to be? Another element of BFI 2.0 is that it pivots from weakness to strength. So what I said before about pathologizing normal human behavior, well, there is an older model of medicine, a disease model of medicine that basically says, if somebody's sick, let's cure them. And management has adopted that over time. But the whole field of positive psychology, and I'm not sure if folks are familiar with it, but this is basically the science of happiness that was invented by Marty Seligman at the University of Pennsylvania starting in the 80s and 90s. And now go to the bookstore at O'Hare, at Barbara's Bookstore, half the books are in positive psychology. There is a massive and well-funded and constructive evidence-based research into what makes a life well lived, connecting Aristotle's concept of eudaimonia 2,400 years ago to collecting evidence as to the value of gratitude, the value of community, the value of many other things. Behavioral 2.0 is a massively wide vista that gives everybody here the next leg to their career to connect to their clients in a way that really matters to them.
You mentioned something in there like AI. By the way, you can put questions into your app. You'll see me playing on my iPad every once in a while so that I can approve them, and then you can vote them up or down. And we got an AI question that I think we'll work in there a little bit. But ultimately, this idea that whether you're an advisor or a money manager or an analyst, we're often thinking of how do we solve that problem? And we're looking at the behaviors as something to solve. And I've always thought you can't take the human out of human behavior. We have to build solutions around them or construct them within. And I feel like in a world where AI can generate a financial plan or an allocation, and maybe it can't do it perfectly yet, the human edge, as you mentioned, is going to be that emotional intelligence. And it's going to be asking better questions. You mentioned joy. It's a great example. You said you have to listen like a therapist. Everybody here in the room is probably in the finance profession, whether you're working with individual clients or analysts or executives or institutions, you have to really hear what the people are saying. How can you do that? You can ask better questions. There is an art to asking better questions, right?
Absolutely. So when we work with clients at Shaping Wealth, and they could be one-person RIAs, we have clients who have more than 10,000 advisors on the platform, and we create design learning journeys for any number of those firms. The opening framework that we use is what we call mechanics versus guides. I was on the investment management side of the industry for 15, 17 years, and now I've been more on the wealth management side for the last decade or so. In the wealth management space, advisors are helping people move along life's journey, doing so wearing two hats, as a mechanic and as a guide, as a technical expert with expertise in building portfolios, putting together estate plans, optimizing for taxes, all those sorts of things, mission critical, non-negotiable in their importance. But the other side of it is that they are guides, that financial advisors are humans helping other humans navigate uncertainty, change, and complexity. Those aren't going anywhere. And our mission statement at Shaping Wealth is we train the guides. 4 words, we train the guides. We assume that you guys are very, very well-trained experts and that you know how to build a great portfolio. Now, we can maybe circle around later as to whether or not AI is commoditizing some of those technical skills. But on the guidance side, well, what are the skills that are relevant and how do you learn them? One of them is asking questions. So a key principle, and channeling Joy Leary again, I would strongly encourage everyone, number one, to understand the power of questions. Questions open up spaces if asked the right way. Questions excite possibilities that might not have been there before. Questions inspire agency that we all deeply crave. So questions they're more deeply powerful than I thought about up until a few years ago, given what we've been building and the types of clients that we're working with. If there's one principle I'd want to share with everybody to really emphasize is that we should think about questions as invitations, not interrogations. We often ask questions as technical experts in order to fact find, to get the information we need in order to build the portfolio in a way that comports with the client's expressed goals or risk tolerance and things like that. We ask questions in a financial planning context in order to understand goals and risk tolerance and time horizon and things like that. There's obviously nothing wrong with fact finding, but in terms of how do financial professionals excel now in an age of AI via question asking, if we think of questions as an invitation instead of an interrogation, it really opens the space, and then there's better types of questions. Ultimately, the referral-worthy moment in our space is really not finding the next NVIDIA. It's fun to try. Trust me, we all know that. The referral-worthy moment is when the client feels seen and heard, and they say, wow, this feels right. I didn't know it could be like this. And they tell their sister or their neighbor or their coworker, and now that person wants to work with you. They want to buy into your advice business or into your portfolio. Invitation, not interrogation.
So if we are addressing a client, I think of when I go into a client meeting as chief investment officer, I don't have any clients of my own, but advisors will call me in when a client is nervous. And I always try to understand the why, because you'll see an email and it will say, my client is worried about XYZ, or maybe they'll even forward the client email and it'll say, I'm worried about XYZ. And I always think, I wonder what they're worried about. They want to know about this news item, but are they worried about their portfolio? Do they just want to know that we're thinking about it? Are they worried that they won't be able to live the life that they had designed carefully with their advisor? And one of the questions that we got in from the audience is, what's the most beneficial messaging to investors during periods of volatility? And are you grounding investors in their objectives? Ultimately, I feel like educating throughout is really empowering. And then when someone does have an issue, it's asking these questions. And so if somebody says they're worried about the markets post-Liberation Day, for example, since we'll kill two birds with one stone, that's a question in there. And I might say, well, okay, tell me what's on your mind first. The first step that I'm going to take is, before sharing what I think, I want to hear what my client thinks. Because as you said, when you ask good questions and you listen and you empathize with them, suddenly you might pick up on cues where your response might change. The problem may not be at all what they are saying it is. They really just want to know, am I okay? When I think of the most recent bout of volatility, anytime you have an election, this is my experience, at least half of our clients are going to be a little upset. What was challenging for me this time around was clients who were upset from like November to like February. And they said, I want to get out of the market. Things are going to go bad. And we say, well, no, stay the course and you do all the things to educate. But then something bad did happen in the market and we did lose money. If the audience wants to know narratives, I point to earnings. Yeah. I say, at the end of the day, remember what you're investing in. Is Coca-Cola going to stop trying to sell soda? Is McDonald's going to stop trying to sell cheeseburgers? And when you see the big fluctuations in price, that's largely people just pricing in what they think current or future earnings is going to be. And nobody knows. That's why they're big shifts. But that's just the technical piece. So now maybe you've answered the client question, but if you don't ask them questions, you may not actually settle the real issue. So in terms of process or thinking about the different layers of why, how would you advise people think about those situations?
I just want to reflect on the message that you put forth, because it's important, which is that expertise matters and competence matters. The social currency of any society is trust. Trust is essential, but it's hard to achieve. It must be earned, and it's relatively fragile. So the anecdote that you just shared is important because there's multiple sources of trust, conversation, but one of them is competence. One of them is excellence in your craft, because if you can communicate that clearly, and there is a line between communicating your competence and overwhelming someone with information and charts and pictures and things like that they might not be able to understand, then I would say kudos to you for stepping into that breach and giving people a clear perspective on how things might be okay. Because, and you emphasized it, if there's one question humans, all of us humans are asking every single day, 99% of our thoughts are not for us to actually realize, but it is going on. It's the low hum of this software that's always running. It is the question of, am I going to be okay? I'm a little bit of a broken record about that, because as a species, we are the dominant species on the planet for a few different reasons, but one of them is that we have a sensitivity to danger that is so fine-tuned that if anything is off a little bit, either physically or psychologically, we sense it, and that fight or flight tendency kicks in. We're not the fastest, we're not the strongest, we don't have fur, we don't have claws, but look at us, we're killing it. Way to go, people. And it's in part because we have that survival instinct. And guess what? Our deep ancestors who didn't have that, they're not with us right now. So we've inherited a gene pool that is finely tuned to survive. So we put out the beginning of April, when things got a little bit janky, that Monday morning, I was sitting, we had our weekly huddle. Half my team's in Europe, so we do it early morning in Chicago. I was like, guys, we have a lot to do, but time out on everything. Let's communicate to our thousands of clients throughout the world ways to talk to clients in a manner that is going to be constructive, because these are the times when you earn that trust, you keep that trust, you're doing right by your client, but you're also widening the moat on a profitable business by doing the right thing. One of the things that we sent out, and we put this together a year or two ago, we call it our laser protocol. The Compass platform has all of this. I can't recall if it's right there to click and download, but we designed a protocol called LASER. Listen, assess, scaffold, educate, revisit. And we do hour-long seminars for advisors on how to execute the LASER protocol. But basically, let's go to the E first in LASER. All of us here, CFA charters, MBAs, PhDs, we're kind of a smart lot. Good for us. So in a generous way, in a virtuous way, we want to share that knowledge with others. Hey, you've got a challenge. Let me tell you what's going on. Let me give you stuff that's going to help you understand the world. And we make the presumption that that wealth of knowledge is going to be the solution to what ails them. It usually isn't. As another human tendency, facts don't really change our mind. We're actually wired so deeply with narrative that we spend most of our time finding fact patterns that reinforce what we already believe. It's known as confirmation bias. So listen, assess, scaffold, educate, revisit, and I'll get to the other four letters. The tendency of most of us in this room, my tendency still, and I work on it because I'm not always great at it, is here's what you need to know. We want to educate. We want to give them a graph. We want to do that sort of thing. It's not the most effective way to solve your client's problem and to extend and scale that trust. You'll get there, but there's other things that you need to do. The first is to make it very clear that you are listening. And that could be in the questions you ask. It could be in what you don't say. You know what we're really, really terrible at doing, all of us smart people in the room? It's this. It's shutting up. That's awkward. Listening involves not speaking a lot of the time. And as you can tell, I have a hard time with not speaking. Assess. Okay, you've created a safe space in a real way, not a woo way, but you have a safe space. Now you're going to ask some questions. Okay, what's going on? How are you feeling? One of the most important, if not the most important finding in applied modern neuroscience is that emotions come before cognition. That emotions aren't, to use a $10 word, epiphenomenal. They're just not another thing. There was a great book called Descartes' Error that came out, 20 years ago by a neuroscientist named, I think, Damasi. And he said, we are not thinking creatures who feel, we are feeling creatures who think. This is one of the most important findings of modern neuroscience. Emotions, and here I'll go to Lisa Feldman Barrett. If you're going to read one book other than The Geometry of Wealth, read Lisa Feldman Barrett's 7.5 Lessons About the Brain. It takes about 2 hours to read, and it's 7 chapters and then a very short chapter, I guess that's the half chapter, on what we know about the brain here and now. So we're going to assess through basic questions what they're feeling about that moment, and those feelings are a source of information. They're not something, as BFI 1.0 would say, hey, let's get through the thicket of emotions to get to what's real. What bad advisors do is they say, let's get rid of the emotions and focus on the facts. Let's do analytics. Sorry, that's just not the way we're wired. So we're going to assess. Third step, S, scaffold. We're going to scaffold curiosity. Now that we've empowered them to know that they're being heard, we've built the grounding for some basic questions, we can encourage them to explore not just what they're feeling, but what they're thinking, what their situation is. Great. Boy, we have an amazingly rich context now, right? Now we educate. Now it's the time to show the line chart, the graph, the bar chart, to bring in a little bit of technical wisdom. That's when it's going to be most effective because you've really created a fertile field that you could then harvest. And then listen, assess, scaffold, educate, revisit. There's got to be a plan in place, right? So now we go to the plan and we say, hey, had we thought about this? And if we had, great, let's follow through on what we were already thinking. Oh, we hadn't planned for this. That's okay. Plans are valuable for about the first day that you write them and then become outdated. Why? Because life happens and life's unpredictable. So you revisit the plan and the plan becomes that stable place in the storm, and you reinforce not just what's in the plan, but the purpose of a plan generally. Remember, treat plan as a verb, not a noun. A plan is a noun, something that you sell for $2,000 and update and resell a year or two later. That's a very different experience than getting into a planning mindset. So that's one of a few methods that we use with our advisor clients who then transmit that to their end investor clients. But that LASER method, it's actually pretty straightforward and it's effective.
I absolutely love the framework, and the idea of an invitation rather than interrogation is important. And you did list one or two examples, but I guess briefly, if you're going to start with the emotion, what are some questions that you feel like act as the invitation for sharing that allows you to move into some of the data sharing and some of the storytelling?
Sure. Let me suggest a few. And to be perfectly honest, where we are now here in 2025, ChatGPT, have a conversation with Chat from your own voice in terms of, hey, what are great questions that I can be asking in the context of my client meetings? We're content creators. We've written books and done all this cool stuff, but it's become such a good resource through the lens of experience and what we've seen work in the field. Let me suggest a couple things. The first one's maybe a little bit weird, but it could be hopefully the most powerful thing I share with you today. And it's actually not a question as much as it is an instruction. So you say, how are you feeling? And they say, I'm nervous, I'm anxious, I'm sort of okay. You know what you do at that point? 3 words. Tell me more. When's the last time you've said to somebody in a social context, professional or personal, tell me more? Again, we're smart, we're eager. In a virtuous way, we're curious and we want to dig in. Oh, you're going to Barcelona? Oh, I went there. Stop. Be empathetic. Just say the words, tell me more, and you're going to be surprised at how the body language of the conversation changes. The power of questions actually comes as much through follow-ups as it does from the initial question. The initial question, hey, how are you feeling about what's going on? When you say, tell me more, you are going to turn on the light in a dim room that gives them permission to go to some places they probably didn't know they were going to go. So that's the first one, tell me more. Another one, I'd like to think through the lens of what's known as the future self. There's a professor at UCLA named Hal Hershfield who's done a lot of the pioneering research in social psychology on this. It's basically the idea that we all have some kind of vision of who we are going to be in a year, in 5 years, in 20 years, and so forth. And Hal and others, and Hal's an advisory board member of ours and a good friend, one of the things that he's shown through MRI imaging and other hard technologies like that, now you could do it with an app on your phone. You couldn't a few years ago, but now you can. You can look at yourself. You could digitally age yourself through this app. Generally speaking, the research shows that those who have seen a physical image of themselves 30 years in the future have a higher savings rate. Our memories are massive, messy hard drives. About half of your memories never happened. Different lecture. Your imagination is a thumb drive. It's tiny. It's not particularly powerful. We're not very good at imagining much of anything into the future, including who we're going to be. But when you can see yourself, physically see what you're going to look like, Hal's research and others' research have shown that you can almost have a conversation with that person. We have future self exercises for financial advisors that aren't weird or woo or creepy. It's just like, hey, let's think about your goals, but in the context not just of what you want, but who you're going to be. So that's the context for future self. It's absolutely fascinating research. And you can frame in terms of the questions that we might go, let's think about 5 years from now. What do you think you'll remember about this moment? What are the memories of your future self? And it gives them a distance from what they're feeling right now, because what they're feeling right now might be anxiety. It's certainly fear. It could be envy. It could be regret. But if you get them out of the now and get them into some positive version or vision of their future self, and then ask, in 5 years from now, what now do you think will have been important? What do you think you'll have remembered? It's powerful. The last one, which I'll do in 10 seconds, is just ask the question, what if we did nothing? It's a jarring question. It doesn't signal that you can't do anything, but it kind of clears the deck a little bit in terms of we can do lots of things, something called action bias. Don't just stand there, do something. What if we did nothing? And it excites the possibilities of inaction and why that might be constructive.
I love that you mentioned Hal, and I sometimes forget that we are technically recording a podcast, at which point I'd say, oh, I'm going to link to Hal's episode in the show notes at thelongterminvestor.com because he came on and spoke an hour about your future self. And in that research, the thing that I remember standing out to me is that our brainwaves, when you think about your future self, are exactly the same as how you think about a complete stranger. So when you're saving money, you're basically giving it away to somebody you don't know. These questions that you introduce, I think, are really impactful. We're getting a lot of feedback from the audience that that's what they're looking for. But something that I wanted to touch on as well was storytelling. I actually did a session earlier today with the Career Fest, and people were asking about AI, and AI is only as good as the information that you put into it. And yes, it can tell stories, but I do feel like the one part of professional development that doesn't come through in anything like the CFA curriculum, it doesn't really come through in any sort of data-driven analysis, is bringing these ideas to life. You mentioned earlier that we learn through storytelling. My perception of the advisors at our firm, when they hear, well, I have to learn to tell stories, it's this big, daunting, overwhelming task, because a good story has a beginning, a middle, and an end. But a story can be as simple as an analogy, as simple as something that makes the information feel more tangible. Talk to me a little bit about your view on the role of story playing, both for the client to advisor relationship as well as the investment professional.
I absolutely love this topic. If there's one thing I like to research and write and create content on, it's this general topic of story. So one quick point and then a slightly longer point. The quick point is that there's a difference between storytelling and story selling. There's really good programs on story selling. Basically, when you make your sales pitch into a narrative, it's going to be seen as much more compelling. Nothing wrong with that. That's great, assuming you're selling something good and useful. But we're not talking about story selling. What we're talking about is being empathic advisors and investors so that we can understand who our clients are. And this is storytelling. This is understanding. There are a couple really good books on the neuroscience of story that have just been published in the last few years. Basically, what they've concluded is that story is the brain's decoder ring, that everything that comes into our minds consciously, but mostly subconsciously, fits into a narrative that we are telling or a series of narratives. One of my favorite facts is that 11 of the 15 highest grossing movies of all time are the exact same movie. Anyone here ever heard of The Hero's Journey? Jeremy has, and it's not Roadhouse, although maybe it could. I'll get to Roadhouse later. There was a professor of mythology at Swarthmore College named Joseph Campbell, and he wrote an unbelievable book called The Hero with a Thousand Faces. And he read across stories and myths from hundreds and hundreds of societies throughout history. And he observed that we have been telling in one way or another the same story over and over again. Wizard of Oz, Matrix, The Devil Wears Prada, The Lord of the Rings, Avatar, Shawshank Redemption, you go down the list, they are basically all some version of the hero's journey in which the hero is called to something bigger than themselves. They're going to leave the Shire, but they hesitate. But now they got to go and they fight dragons of one kind or another. Andy in The Devil Wears Prada, she's up against Miranda Priestley. I actually did this once because I'm a super nerd about it. Devil Wears Prada and Star Wars are frame by frame the exact same movie. He finds Obi-Wan Kenobi. She finds Nigel, and together they traverse the unknown. And as a result, Andy becomes the next version of herself, just like Luke transforms into the next version of herself. This is kind of fun and maybe a little bit trivial. The really deeply important point is that what we can all do a little bit better is listen, and back to the listening skills, back to the questioning skills maybe, as to what stories we live by. And so whether you are an investment professional understanding how to build a better portfolio for a client, certainly your financial advisor building a better plan for a client, not just what do they want to do, but who is it that they want to be? I'm going to mention the I word, identity politics. It's kind of toxic. But the fact is that we all walk around with multiple identities. I'm a dad, I'm a husband, I'm a dog owner, I'm a writer, I'm an entrepreneur, I'm a Steelers fan, I'm a Cubs fan, I'm lots and lots of different things. And what we're doing every day is optimizing the outcomes for multiple identities. So when you're talking to a client, there's presumption in their industry that the only thing that matters is more. The only thing that matters is, I've got $2 million for retirement. Boy, $3 million sounds kind of good. You get to $3 million. You want a little bit more. Don Draper said in Mad Men, happiness is that feeling right before you want more happiness. The same thing is true when it comes to achieving more for our goals. We always want more. The real magic happens when we listen to the people around us and get a sense of not just what they want to do, but who is it they want to be and how can we help them along the way. This new BFI 2.0, this intersection of human behavior and financial planning, where I operate every day, it is very much a narrative exercise so that, you can have all the lines that add up to something called a portfolio. That's the what. But what drives the what is the financial plan. That's the how. That's where we're going to get. But prior to the how is the why and the who. So purpose drives the plan drives the portfolio drives the subparts. You can add value at any one of those stations, the what, the how, or the why. You just have to be conscious of where you are in that process, and that story defines the entire thing.
Before I turn to the audience questions, one more thing I'd like to talk about is maybe the invert of what we've been talking on. Behavioral insights often tells us what we can't do and why it makes us bad investors. Mm-hmm. How do you feel that behavioral insights can make us better investors?
I guess I think about this in concentric circles, and maybe I'll just focus on the innermost one, which is, can behavioral insights drive alpha in the sense that CFA charter holders would think about alpha in a traditional sense? I think I have mixed feelings. Let's take two big factors, value and momentum. There are human tendencies that drive both of those phenomena. But can you use those behavioral insights into those factors or others in order to be a better investor? In 2025, I'm not sure, because I don't know how much edge there is generally in that. And I'm really not convinced that a deeper understanding of the human condition in the narrow sense of line items for a portfolio is the way that we're going to add value. I mean, I think I'm operating on a broader scale where I'm asking what helps humans flourish. Where are we sourcing deep sources of contentment? The geometry of wealth. I coined this term funded contentment. The idea that true wealth is the ability to underwrite a meaningful life. And so everything that I do in my day-to-day is, okay, how can I help advisors and their clients achieve funded contentment? Well, behavioral insights help there. I'd pass it back to you, Peter. You're CIO of a big portfolio. Where does human behavior fit into your ability to add alpha, have an improved Sharpe ratio, all the things that we as professional investors do care about?
It's interesting because I truly believe that the work that you do to coach advisors is where any end client is going to get the biggest impact. And if a lot of your decision-making process is around timing or security selection, I actually fear that an understanding of the behavioral errors maybe gives you too much confidence in your ability to avoid them. How do we minimize all our biases? I don't think we do. I think you can acknowledge them. And when you're in a group setting, so as I chair the investment committee, we have 4 voters, but there are 9 members. That's a lot of voices. And you can look at decision-making theory, and groups make bad decisions, pretty broadly speaking. And some of it's for behavioral reasons. Some of it's just because of social dynamics. Where I try to spend the most time is recognize what are the biases that we can lean into, and how can you be more process-oriented, and how can you automate wherever possible. Generally speaking, if you're making an investment decision, whether you're an individual or you're making a fund recommendation as an analyst, or you are putting up something for a vote at the investment committee, writing down the reasons why is important, writing down the reasons that you might be wrong, writing down the reasons that would make you change your mind. And then the question you had even pondered for an individual client, how will you feel about this in 5 years? What will you remember as being important? Because when we look back on a decision, we know that you're supposed to be judging process, not outcome. And what information did you have at the time? For example, in 2011, the firm I worked at, we increased our allocation to international stocks, which everybody here knows was probably a bad time. What was interesting is at the time, the data from 1970 through 2011 showed that the returns of an international portfolio and a U.S. portfolio were the same, because the U.S. had just come off a bad decade. Fast forward to now, and it looks so obvious that we shouldn't have increased the international allocation. And that was at a prior firm where I just had 1 vote. We are addressed with our allocation every single year now. And you know what? I don't change the allocation, because the research shows me that we own international because it's supposed to be diversifying, and that you can get that benefit with anywhere between 20 and 50% of your portfolio. And if I change the allocation for any number of data points, I'm probably going to get the timing wrong. And I speak to others. I actually know a firm who just increased their U.S. allocation at the beginning of this year. And that went really bad for them after being underweight U.S. for the past decade. And that's a really painful thing to do. So I think behavior is just recognizing for how do you improve the process? Well, we're bad at predicting the future. So try to have process, try to automate where possible. And if you're an individual, the best form of automation is getting an advisor. And that's when you really start to minimize.
2 things. One is, if we're optimizing for helping the clients to live the life that they want, we actually end up getting a lot of wiggle room in the portfolio per se. And whether we have nailed the US versus international, small cap, large cap, whatever factor tilts that you want, they actually matter a lot less, because the question that client is asking is, am I going to be okay? Am I going to be able to achieve the things that I want? The second thing is, real quick, you had mentioned there was a question there, how do I minimize biases? I'd really want to challenge that framing and that question. if we are still in a place where we are thinking about our natural human adaptations to a long evolutionary chain as mistakes or flaws, then we are just still driving down into that cul-de-sac and ending up nowhere. So we are not here to minimize biases. We are here to understand what is going on with other people and help them plan their futures accordingly. And that's a different venture, and maybe that's not what everybody wants to do. But behavioral finance 1.0 is, hey, we're so flawed, let's see if we can fix people. No, that is simply not the way the brain works. That is not the best way to serve people. Behavioral finance 2.0 is this much broader pivot to understanding how humans flourish and leaning into that positive stream.
I'm going to ask a pretty broad question about AI, so I don't influence your answer, and then maybe I'll riff a little bit off of it. But broadly speaking, what do you think about the role of AI among the topics that we're discussing right now?
So I give a keynote talk called Augmented Humanity. So I've tried to think about this a fair bit in terms of where does AI fit in? Because look, we're all playing around with this, right? Some more than others. And the power is insane. The ability to have a conversation with an AI about any topic. Now you do it voice activated. I can drive down the street and just be talking to the name of the avatar that I gave it. It's really powerful. Let's just anchor on one concept, and I'll just plant a seed for this. And that is empathy, which is, can artificial intelligence be empathetic? To me, the answer is yes, but there's different forms of empathy: cognitive, emotional, and experiential empathy. Cognitive empathy is understanding where you're coming from and being able to respond accordingly. AI has an extremely high level of cognitive empathy at this point. Let's assume that AI can just use a voice engine and it would be a voice that you would recognize, the tone and everything. You'd think it was a person that you knew, and it is just using the words from AI. The responses would make you feel seen and heard. That's cognitive empathy. Emotional empathy, it's much harder to argue that AIs have emotional empathy, and that's largely a function not of the AI, but of us. Emotional empathy is what I call demand-side empathy. We like to know, for one reason or another, and there's a few reasons, we like to know that we are just talking to another physical human being. It's why that we are intolerant of accidents for a Waymo, but we're very sort of tolerant. Hey, people get in accidents all the time. But if it's more than 0%, so everyone here understands base rates. I don't remember that was in the CFA exam. Base rates kind of don't matter. So we are very intolerant, and therefore AI does not really have emotional empathy. The third tier is experiential empathy, which is, can you follow through on things? And there AI does quite well. So it's a mixed bag. And a psychologist who's written on this a fair bit in his blog, a guy named Paul Bloom out of Yale. So if you want to explore the idea of, can AIs be empathetic? Paul Bloom's a good person.
You've mentioned a lot of resources today, and some of the questions are around like, hey, can you say that again? And I'll remind you, on May 28th, the show notes for this episode will be available on thelongterminvestor.com. We'll have links to everything. We have brought up storytelling a couple times. I want to address this question. There's a chance it could be our last one. And you and I have talked about this offline. I'll just broadly ask, do you think we should be including storytelling and influencing skills into the CFA curriculum?
I do think so. I think that understanding what makes us human in an age of AI, in a time, in the VUCA, coming full circle, in this VUCA type world, being able to be better conversationalists, to understand that empathy is a skill. IQ is fixed. No one here is getting smarter or dumber ever again. EQ is like vertical leap or chess or cooking. You can be a little bit better than you are right now. Doesn't mean you're going to be Oprah on the empathy front or Michael Jordan on the vertical leap front, but you can be a little bit better. And there's no doubt that those skills, I can see that kind of behavioral coaching, listening skills being they are very important. And I think it's fair to say that the soft skills are the harder skills to obtain. You can learn the technical skills, but guess what? The more process-oriented those technical skills are, the more likely it is AI can perform those functions in a second.
Well, Brian, thank you again for joining me, and everybody here today. Thank you for joining us. Again, thanks all for the questions and your attention. Be sure to listen to us. You'll see this on TV on Cheddar News, as well as on the podcast at thelongterminvestor.com. Thanks.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.